Hi, everyone. Investors have had plenty of headlines to digest lately, from ongoing developments in the Middle East to rising bond yields, inflation concerns, policy uncertainty. The list goes on. Yet markets have continued to hold up remarkably well. The S&P 500 ended last week at an all-time high and is up more than 13% this year. And this hasn't just been an AI-driven rally. That equal-weighted version of the S&P 500, which gives every company the same influence on the index, is up nearly 15% this year, suggesting that average stock is participating as well. Now, a big part of this resilience comes back to fundamentals. Markets can look through a lot of the short-term noise when corporate earnings, revenues, and profit margins remain healthy, and that's exactly what we're seeing this earnings season. We're now nearly 90% of the way through this reporting season, and about 86% of companies have beaten earnings expectations. What's perhaps even more impressive is that 8 of the 11 sectors in the S&P 500 have delivered double-digit earnings growth over the past year. Overall, earnings are up roughly 50% from a year ago. That's 50. And that's the strongest growth that we've seen since 2021, and it's roughly double what investors expected before this reporting season began. So coming in well ahead of expectations. There's an interesting wrinkle in this number. Alphabet and Amazon reported roughly $98 billion and $53 billion, respectively, in gains from their investments in private companies such as Anthropic, OpenAI, and SpaceX. And these gains were largely on paper. This $150 billion in total additional income was not actually additional cash that was coming through the door. And so because these valuations, these private companies, and obviously SpaceX is no longer private, but it was at the time, these valuations can move in both directions. And so what boosts their earnings today can potentially become a headwind tomorrow. We know these things can be volatile. But if we strip out the impact from Alphabet and Amazon, the S&P 500 earnings growth falls from roughly 50% to closer to 32%. And that sounds like a big adjustment, and it is, but I actually think it reinforces the larger point. Even after removing these gains, corporate earnings are still growing more than 30% on a year-over-year basis. And that strength extends well beyond earnings. Revenues are up about 15% from a year ago, with every sector of the S&P 500 reporting positive revenue growth. And one reason is the strength of the economy in nominal terms, which includes both real growth and inflation. So nominal GDP grew at a roughly 8% annualized pace during the second quarter. That provides a really strong backdrop for corporate revenues. But these companies aren't just reporting more revenue, more sales, they're actually keeping more of it. S&P 500 operating margins reached 18% during the second quarter, and that's a record, and also about 4 percentage points higher than the pre-pandemic average. So let's put all these pieces together. Revenues are growing, companies are converting more of those revenues into profit, and that's translating into exceptionally strong earnings. I think that's an important reason markets have been able to look through so much of the noise lately. And this doesn't mean that geopolitical risks, tariffs, inflation, interest rates don't matter. They definitely do, but the question for us as investors is whether those developments create temporary volatility or become significant enough to change the fundamental picture. So far, corporate America continues to provide a very strong foundation. None of this guarantees that markets will move higher in a straight line. We know that they rarely do. But for long-term investors, it's a useful reminder that the headlines that move markets from day to day and the fundamentals that drive them over time aren't always the same thing. And that's why we try not to make long-term investment decisions that are based on short-term noise. We stay focused on the underlying fundamentals, maintain diversified portfolios, and we make adjustments when the evidence, not simply the headlines, suggests the environment has meaningfully changed. Right now, the fundamental picture remains healthy. I'll leave it there for now. Thanks so much for joining us, and we'll see you again next week.